a lot of this is very straightforward. You got to plug numbers in. So, CAPM, it's the most famous formula in finance. It says that the discount rate per stock is a risk-free rate plus beta times the market risk premium. The risk-free rate, we're going to use the 10-year treasury. If you don't get anything else, that's just the most common. So was it 4.5%? Do everything's in decimals. Don't write percents down. We'll do the beta here in a second. The market risk premium equals the expected return on stocks minus the risk-free rate. So we're using the implied approach. Expected return equals, well, it depends on what she gives you. She believes the economy, so we're going to use yield plus nominal GDP growth. That's somewhat implied from her answer. So your boss using 10-year treasury even tells you that. She believes the economy productivity will be 2.25%, but she gives you the whole answer down here. You don't have to add them up, 5.5%. So she says the economy is going to grow 2.25, 0.75 plus 250. That's 5.5. So she gives you the answer down there. So A equals yield plus 0.055. She uses the implied approach, assuming a current dividend yield for stocks of 1.4%. Where do you need Ross dividend yield? In this entire exam, not in a single place. So 0.014. And she does the stock buybacks, which you're going to want to do on your paper 3. You're going to get some really, really wild answers. So 1.5%. That gives you, oh my word, what was that, 8.4? So your market risk premium is 0.084 minus 0.045 equals 0.039. Does that look right?
Yeah.
That's what team 6 had, so probably right. And so risk-free rate, 4.5 plus beta times 0.039. So on beta, you have 4 steps. Someone tell me the 4 steps real quick. All right, so is it defensive or cyclical? Second step, operating leverage. Third step, leverage. Last step, history. All right, good. So is this a defensive or cyclical stock? Probably defensive. They give you a little bit. I've never been in a Ross store.
Wait, you've never been in a Ross store?
Never in my whole life. I mean, you could argue cyclical, but once you might want to look at the graph first because you're probably going to be, the graph's probably going to be influencing you some. But this is off-brand, low price. So it's a discounting apparel. Apparel is high beta, but discount apparel is lower beta. If you want to push it closer to 1, that would be all right. Just
Not in finance, they put Ross into the cyclical sector.
yeah, some people do. Some people target in cyclical. Some people target in staples. Some people put McDonald's in cyclical. McDonald's is a good example. Restaurants are cyclical, but McDonald's is often looked more like a staple. The thing here is that there isn't, you could argue one way or the other, but just make sure you're logical. All right. Don't say they're defensive because they sell a high price, the durable good. Doesn't make sense. So I'm going to say defensive because is heavy discount apparel. I can't spell apparel. Clothes. So clothing could be considered cyclical. I mean, if you want to cover your bets, you could do that. Ross is an extremely well-run firm. I've always thought naming their store the Dress Barn wasn't the smartest thing in the world to do. That sounds kind of wild for someone to go buy dresses in a barn. But they're very successful. That might be intentional, that they want people to think, hey, we're not snobbish. We're for the the average person out there, whatever. What about operating leverage? What are you gonna look at there? So it's probably hourly labor. And then what you can say about their net margins? The standardization of net margins is pretty low, plus very stable net margins. So low operating leverage. Financial leverage, higher than average. So this might say, hey, beta below 1, maybe 0.8, 0.9. There's more than one right answer here. Operating leverage, maybe pull beta down to 0.7 to 0.8, something like that. It's not going to be radical. Financial leverage, move us back up, say 0.75 to 0.95 maybe. And then we look at history, we see that the median is 0.8. Most of y'all probably use 0.8, but you could argue something higher. This is a perfect example why you don't use Yahoo Finance, because Yahoo Finance would have had you at essentially 1.1, because all it shows is that very, very last dot. And if you're thinking, it's a cyclical stock, and you see that 1.1, you say, oh, that makes sense. They sell apparel. But when you look at the history, they've actually done a pretty good job of diversifying portfolios. They've had betas below 0.8 50% of the time. When they're above 0.8, kind of comes in spikes. I don't know why they would have spiked in the .com era. I don't know why they would have spiked going into the financial crisis. They came back down afterwards. So it's hard to know why they spiked. That's part of the problem with beta. Beta assumes the relationship should be much flatter than it is. Well, but that'd be true if people can afford more. So during a good economy, they're buying more Ross. Usually, if you can afford more, they can go to Macy's or Nordstrom's. So I don't know. I mean, if it's hard to say. To me, it's more of which industry is driving markets, and I can't remember 2017, 2018. It's really hard to say. So you can't always get a logical. A lot of times, beta is entirely noise. If they happen to have a big stock day on the day the market has a big day, beta just assumes it's systematic risk, and it could be that they announced something that day, just purely coincident. They were up 10% when the market was up 2%. And remember, beta is very sensitive to outliers. So it can just be complete noise. And that's why you'll sometimes see it shoot up like that. And it stays in that number and then it comes back out. So, all right, so I'll use 0.8. Make sure you go through all these steps. On the exam, I don't need a whole lot of discussion, but on your paper 3, you need to really at least have a paragraph for each one of those things. And remember how you can add more value to this? It's to look at this data more than just at your company, but maybe bring a couple of others in to get a whole lot of extra points. Do this chart, not just for your company, but a couple of competitors too. That really helps you know, is there something unusual about my company's beta? Maybe they shot up in this year, but no one else did. So it's probably the noise in beta. So beta is very sensitive to noise. It can be fooled by just random stock price moves. Now, if you look at Ross today, I don't know why there's a T in there. Ticker, your beta is still up at 1.1. So it's stayed up at 1.1 the last few years. I don't view it as a 1.1. I could go 1.9. Like with Target, I can be 0.9 to 1.1 on Target. It's going to definitely be higher than Walmart. Ross will definitely be lower than Nordstrom's and Macy's, no question. Lower than Abercrombie and American Eagle. Their discount. Same thing with TG Maxx. I never been in a TG Maxx either. Is that a good store? Is it pretty decent? So I do all my fashions at Walmart and JCPenney, so I don't go to those high-end stores like TJ Maxx. But you can kind of argue, but you can see why having that 1 point doesn't really help you. You need to look at that history and get a good sense of what could be argued, and then see if the history is consistent with what you said with your list. And so we put 0.8 there, and I don't know what answer that gives me. There's more than one right answer. So anybody got that? Some of y'all get 762. I'm seeing a lot of different numbers. We'll see. Y'all did well on the bond one, so we may have to do this one again. We'll see how y'all do on this one. All right, so there's your answer. It's all of that stuff there. So the way the exam works is I pick a company, and that company is used throughout the entire exam. When you do the stock valuation, I'll actually give you a discount rate. That helps me, so I don't have 20 different answers, but it also helps you because if you get a really bad discount rate on question one, it doesn't mess up your question two. Like if you get a 4% discount rate and my growth rate's 5%, you really can't do question two. But there is a trick. If you look at question two, my long-term growth is 6%. What do you know about your discount rate in question one? It's got to be greater than what? It's got to be greater than 6%. So if you get 4% on question one and my growth rate on question two is 6%, you probably did something wrong on question one. So you might want to rethink. All right, so I'll save that. I might put it on Canvas as I remember. All right, so what are the markets doing today? Let's see if y'all remember anything from the first couple of classes. What's the S&P doing? Can anyone say? So what's a 1 sigma on the S&P? 1 sigma day on the S&P is what? That really round number. 1%. So what's the day? Big day, decent day. So the S&P was up 20 points or 0.34%. The close hasn't closed yet at 59. We haven't closed above 6,000 yet, have we? I think we've gotten close. We've been over 6,000. Pretty important number. We are over 6,000. Oh, we did. We did close above 6,000 for one day. We were above it the entire day. We opened above and closed above. So 60.17. So we've come off since then a little bit. What are bond markets doing today? First of all, are they rallying or selling off? Rallying, and is it a big rally or an average rally? What's one sigma here? 6.5. That's 3.5. So it's a decent rally. It's not massive. Remember, we're worried about us hitting 4.5 again. So we've come off of that quite a bit. We're back down below 4.4. So it's come down some. Trump is picking his Treasury Secretary. That's going to be pretty important. There's been a lot of debates on that. I think he just picked his SEC chair or SEC, whatever. That's going to be an important one, but not so much for interest rates. So it'll be interesting to see. Oil prices have been down a bunch, back below 70 bucks. Gold has come off of its records, but it is up today. So keep watching markets every single day. Make that a habit. All right. Papers 3 and 4, you now have my video.
So it's not available for my classes because
So I walk you through papers 3 and 4, step by step. But I don't want an Excel spreadsheet. So you do it all in Excel. I would recommend you set up your Excel spreadsheet just as pretty as I did this one, so that you can use it for another stock. It goes through the process. You got a good template. You could easily do it for another stock very quickly, especially given that your risk-free rate and your market risk premium are going to be the same for everybody. And your long-term growth might be similar for everybody. So then it's just a matter of changing the other inputs. You can value another stock fairly quickly. I put a data table at the end. I'm not requiring a data table, but I do like data tables. I don't use Excel data table. I don't like it because you can't manipulate it. So I just create it by hand. I think it's a lot easier, goes a lot faster. If you want to do an actual data table, that's fine, but it is a lot harder to set up. But I do like the data table. It looks impressive. Gives you a good sense of if the stock's over or undervalued. And if you get nothing but greens and nothing but pinks, like usually when people do Costco, they get nothing but pink, looks overvalued. I agree with that. I think Costco is expensive as much as I love Costco. With Walmart, my first time I did it, it looked really, really cheap. And then I adjusted it. And then it doesn't look quite so cheap. But you know, do your analysis, but you don't have to do a data table. But the reason I like data tables is, first of all, the CFA Institute, they recommend it. Secondly, a point estimate when you're forecasting out 100 years is pretty arrogant, I think, that we think we can forecast out 100 years. So I always think in finance, I think in distributions. My medium, my upside, my downside. And that to me just makes more sense. But it gives you a decent way to assess the stock. You know, color code it so it looks good. But anyway, you got everything you need there. And in the very end, you have to have a final recommendation. Don't forget the final recommendation. Get into your notes. You cannot do a final recommendation if you don't have the current stock price. It amazes me. A few students, they say, I'm recommending on buying a stock, and they never tell me what the stock is worth. They say, I value the stock at $97. I recommend a buy. What's the current price? Is the current price 150 bucks, 50 bucks? How do I know what you're recommending? If you want to get really good at this, then go on to Merchant Online or go to Bloomberg and get a sell side report. Have y'all ever seen a sell side report before? They have, I mean, it looks really professional. So if you want to try to emulate that, that would look really good on LinkedIn. I can show you one on one of my classes. I don't remember where I put it, but it's out here somewhere. Oh, here. No, I don't know where I put it. It's somewhere out there. You see it? I don't. So why don't I see it? Oh, yeah. Here we go. I don't like either one of these except for format. The writing is atrocious. It's really kind of embarrassing, the writing, but the report looks good. So usually, for some reason, they do this narrow column and wide column. You say who your firm is. This is Cohen. They don't have their firm up there. Who the analysts are. And then they'll have the price and the target price. And then they'll talk about the firm. Their writing is just really, really bad, but that's the typical. Have y'all seen anything like that? There's Cohen. You have that up, who you're doing the analysis on. That's the sell side research. So the sell side, they don't actually buy and sell stocks. They just give recommendations. They're like consultants. They just give their outlook. So if you wanted to emulate this, you can get these off of Merchant Online through the library, online library, and you can get them on Bloomberg as well. You just go into Bloomberg and search for the analyst reports. And that type of format, if you did it on the sell side and then put it on LinkedIn, it's just much more impressive. You could give your firm a title, a name, and do your research. There's one. Let me show you one other one. I wish I could show you one with the UTSA alum. I had one from JP Morgan that was a UTSA alum, but I can't find it anymore, and he's no longer there. He went to the buy side. But you put your name up there, you have the firm, you have your target price. They show the current price here. They have a little bit of data here. But again, you see that 2/3, 1/3. Here they did it on the right side is narrower. And a lot of times what they do is they'll have one side with the text is wide, and then the narrow sides where they put their graphics and their tables. So pretty common to do that. You got your two analysts here. So I wish I had the one when Ryan did his for JP Morgan. He was the third one listed down. I think he did 90% of the work, but he was a junior analyst, so his name came last. But he had his name on a report within 6 months of starting at JP Morgan. So it's not like you start doing these 3 years later. He was within he was a newbie at the company, and he already had his name on a report. So yeah, sometimes I put a lot of extra data down at the end, all kinds of stuff. And then they have a longer report where they go in a lot of detail. But that's the sell side. I'm not saying you need to use this format, but I'd just be really impressed if you did. because it really demonstrates that you want to be in that, especially if you want to work on that side of the business. Boy, it's a tough job. A lot of overtime, and it's really bad overtime because it's overtime where you're really sitting there waiting because you don't have anything to do because you're waiting for someone to release something, but you can't leave because the data doesn't come out until 9 p.m. But you got to stay till 9 p.m. So you're sitting there with nothing to do. You're reading. That's what you do a lot of. And then suddenly it's like the world comes apart. Everybody's just scrambling because the data comes in. Because your boss wants that at 7 a.m. when they get there, or 9 a.m. or 10 a.m. when they get there. And it's got to be done, and you just have to stay up late. So a lot of the overtime is not stress like an accountant overtime where you're there overtime because you got a bunch of stuff to do. It's overtime because you got to get it done by tomorrow morning, but you don't have your data yet. Very frustrating. So, but it's a great experience. All right. So y'all can start paper 3. It's due pretty late. You know, you've got like 2 or 3 weeks to do it, but you can do the entire thing sitting at Excel. So get it all done in Excel and then transfer it from Excel into your paper and just tell me what you did in the paper. Any questions on 3 and 4? And do submit it as one paper. Don't give me 2 papers. Just combine it all. Don't even write it as 2 papers. Write it as one paper. I just say 3 and 4 because it's worth twice as much as the other papers. All right, let's talk relative value analysis. This is the most missed question on the exam. I don't know why. So see if I can do a better job this time. Almost everybody, every investor does relative value analysis. Not all investors do what you're doing in papers 3 and 4, which is this kind of cash flow analysis. But almost everybody does relative value analysis. I say almost everyone just because I'm sure that there's probably some hedge funds that don't, but it's hard for me to imagine. So let me talk about how relative value analysis fits in with what we do when you value companies. I'll give you a real estate example because that's where we most commonly use it. It's just really just kind of commonsensical to use it with real estate. And then we get to the exam question, which is, how do you do it correctly? Good relative value analysis versus weak relative value analysis. So there's 3 approaches. I did this in the Investment Society a few weeks ago. There's 3 approaches to valuation. There's fundamental analysis, that's your paper 3 and 4, fundamental analysis. Technical analysis, what that we're not doing. Technical analysis, we talked about earlier in the class. That's where you're using stock prices and volumes, historical data, and trying to figure out if there's a pattern to the data. Is it breaking out? Is it consolidating? Whatever it is. Is it overbought, oversold? Those type of things, technical analysis. If you're interested in technical analysis, Dahlquist's book, Dr. Lowe's book is really good. I need to find, there's a podcast. I forget the podcast, but it's one of the Colossus where he interviews a technical analyst, and she's probably the best in the business, the best known, and she does a great podcast. If you're interested in technical analysis, I'll have to find that podcast again and save it, and then you could probably find her website. She knew how to explain it, just like Dahlquist. Dr. Dahlquist was a UTSA professor. She wrote a book on technical analysis, and she did a great job of explaining what it means. Dr. Lowe makes a good case for it as well. But we're not going to cover technical analysis in this class at all. And then relative value analysis is what we're going to cover here. You can use all 3 of those for asset strategy. For asset strategy, you can use fundamental analysis to figure out the stock market's overvalued. If small caps are overvalued or large cap are overvalued, or US stocks are overvalued versus international stocks. You can use technical analysis for that. You can use relative value analysis of that. In the Investment Society, we're using relative value analysis to show that small cap value stocks are about the cheapest they've ever been, really since the dot-com crash. That international stocks are about the cheapest they've ever been, for good reasons. Europe is doing horrible. China's really bringing down emerging countries, even though India is doing okay. So relative value analysis, you can use that for asset strategy. You can use all 3 of these for security analysis. Papers 3 and 4, you're doing fundamental analysis to analyze a security, not an asset class. Technical analysis, we're not going to do that, but you could take your security and calculate its RSI or do its Bollinger Band or whatever. There's a lot of technical analysis. If you want to do technical analysis on a stock, I recommend you go on the Bloomberg machine and type TECH, and they'll bring up a whole menu on technical analysis. It's a really good menu. You can click on a Bollinger Band, you can click on the RSI, bring up your company, it brings up all the charts. It's really, really good. They do a great job there. And then relative value analysis, you can definitely do that for security analysis. I'll show you what we use in our security analysis class to try to see if a stock's expensive or cheap. So relative value analysis works for both. So really, most people use both. So at USAA, I had to do asset strategy and security analysis, and I used all three of these approaches for both of those. So fundamental analysis is when you're looking at their earnings or cash flows, you're forecasting out, getting a discount rate, and then doing discounted cash flow. That's what we teach. 99% of what we teach undergraduate is fundamental analysis. We used to have a technical analysis class at UTSA. I don't think they've offered it in years. Maybe someone will start teaching it again. It'd be a good class to teach in the Bloomberg lab. All right, so what is relative value analysis? It's comparing some measure of value. It could be price, which is the most common one, and comparing that that's some fundamental factor. There's all different types of fundamental factors. We'll go through the most common ones in here. So it's a market value over some type of accounting or fundamental value, something that's not a market value. So for stocks and for real estate, our measures of value are price or enterprise value. You'll see later, you'll have to know when to use price and when to use enterprise value, right? I think it's really simple, but a lot of students miss it on this second exam. What are the fundamental factors? Anything that you can assess the security against that's readily available. The most common are earnings, revenue, and book value. Those are the most common ones. And there's several earnings ones that we use. What's the most common one you can think of? Price to earnings, y'all heard of that. You're using price and you're comparing it to earnings. Another really popular one is enterprise value to revenue. All right, so for the exam, you have to figure out why do we do price to earnings, but enterprise value to revenue? Why don't we do price to revenue? Why don't we do enterprise value to earnings? And sometimes we do, it depends on which earnings. So you have to figure that out. Why do we always do price to book value? Why don't we do enterprise value to book value? And there are several very industry specific factors. I mean, you can get really specific. One of the things I did was I did the relative value of auto manufacturers and did their market value to how many cars they produced. And guess who was the most expensive auto producer on the planet? Ford. Highest value, but didn't produce many cars. Well, I'm not looking at Chinese companies, but yeah, Tesla by far. Now they've caught up some, but they still don't produce nearly as many cars as Ford and GM, and yet their value is much, much higher. So if you value Tesla versus how many cars they produce, they look really expensive. Facebook, if you look at Facebook at their market value versus how many employees they have, extremely expensive firm. Facebook has very few employees relative. Now they have more employees now because of all this fake news stuff they're having to monitor. So they had to hire them. I don't know how many of those are actually employees. So it doesn't just have to be accounting. You can do all kinds of relative value to any factor you want to do. You can do it to employees. You can do it the number of cars produced. Hotels, you can do it relative value to how many hotel rooms they have. So, you know, you could do Walmart versus value versus how many stores or how many square feet. But usually we do it to accounting numbers, earnings, revenue, and book value. The relative value analysis doesn't really ask if markets overall are expensive or cheap. They're really asking, although you can somewhat do that, they're really asking the question, is this market cheap or expensive versus this market? Is this stock expensive or cheap versus this one? It's a relative analysis, not an absolute. You can use it as an absolute value if you adjust for things like interest rates and inflation, but we're not going to do that. So we're really looking for the terms cheap and rich. What stocks are trading cheap? What stocks are trading rich versus the current market? Well, also, I'll show you, talk about cheap and rich versus their history. Is this stock trading cheap or rich to their history? We'll get into that. I'll show you how to do that. I don't know why, who came up with the words cheap and rich. I would personally would say inexpensive and expensive. But someone was first and they used the word cheap and rich. So we're stuck with that. I don't know who that is. Maybe Benjamin Graham. I don't know. So let's use a real estate example. So some of y'all seen this presentation before, so you know what's coming. But anyway, so you're gonna buy a house. The price is $150,000. That's all you know. You're gonna buy it. Would you put a bid in on this? You don't know the city, you don't know the location, you don't know if it's on a cliff in California that has mudslides. All you know is a $150,000 house. Maybe not. Let's say the price of the house is $150,000 and two other houses sold in the same neighborhood went from $875 and $675. Would you buy it now? You might say, well, the land itself is probably worth $150, but then the land might be on the corner and it's cut in half. Sometimes they divide more than you don't really know. So you're getting more interested though, aren't you? It's starting a little more interesting. If I told you this was in the Dominion, I'd say, wow, what in the Dominion would be $150, 150,000. Let's give you a little bit more information. Let's give you the price per square foot. Price per square foot is a what? That is a price relative. Just like price to earnings is a price relative, price per square foot. What did we do? We took the value of the house and divided it by some fundamental factor. All right. This house is going for $75 per square foot. Comparable houses in the neighborhood are going for $250 and $225. So now you know the size of the house that you're paying pretty low per square foot. You don't know the size of the land. And land is usually about a third of the value of a house. So you don't know everything. But if you had to make your decision right now, would you buy the house? They're not going to give you any, you got 3 seconds. So you got 3 seconds to decide. You don't have time to look at the house. You can't Google it. Would you buy it now? $150,000. You're a little more comfortable now, aren't you? So price per square foot is relative value. What if we get really sophisticated and we go out and we look at everything we can possibly look at that is important to us, and we run a regression? And there's actually someone who's done that. I found their website and I forgot to write it down, but there actually are people who do this. I don't know if Zillow does something like this, maybe comparable, where you bring every factor in. So we already brought in the size of the house. You can ask if it has a pool or not. To me, if it has a pool, that brings down the value of the house. I would just be filling the pool in with concrete, so that wouldn't make me happy. The number of bedrooms, or you might even be asking the size of the bedrooms. You decide what goes in there. How good is the kitchen? Because if you're going to remodel the kitchen, that's probably $40,000, $50,000 right there. If you don't like the kitchen, that's pretty expensive. Landscaping, how nice is it? Are there any trees on the lawn? How good is the paint job? How old is it? How good are the floors? Replacing the floors isn't that expensive. You can probably get them done $5,000, $10,000, especially with this fake wood they have now. That's not all that difficult. The roof, how good of a shape is that in? The fence isn't that expensive to replace, but you could probably think of that. Garage, we may not have garages in the future if everything's autonomous vehicles and we don't own cars anymore, but who knows? What school district? But you could probably think of 5 or 6 other things that would be important to you. That's all related to value. And then you need things related to risk. Is it in a floodplain? California, boy, I'd be looking at that. If the coast is eating in, if the ocean's eating into the coast, there's some places in California where those houses have 10 years before they go they just crash. I'd want to know that. I sold my mom's house a few years ago. We had foundation issues. The guy that bought it from us, I was full disclosure. He could see the cracks. He did an inspection, but I don't think he actually did one. It was really sloppy. My realtor found things he didn't find. It's like, I'm surprised. I fixed the things that were broken, but the foundation did have a problem. My parents got it fixed by a firm that gave them a guarantee. I looked at the company; it was still in business. I bought out the guarantee and gave it to the new guys. So I gave them some assurances, but still it had foundation issues because the ground got so dry there. So this is really important. When you do relative value analysis, You want to compare the market value of the firm to something related to good stuff and something related to bad stuff. You want both of those. Because if you only do one, you have a house that looks really cheap and then you discover that the foundation's about to crack, about to go under, then you didn't assess risk. So you need to look at both of those. Let's say we run all of those factors and we get an R squared of 91% on 350 homes sold. And based on that, this home we're looking at should be going for $150 per square foot, and we can buy it for 75 bucks. And you look at this list and everything you care about is in the list. Would you buy it now without looking at it? Most people would probably want to look at the house, wouldn't they? But if you had to make a decision in 3 seconds, you might be tempted now. At least now you say, you know, I could probably sell this house for 80, 90 bucks per square foot if I did a little minor fixing up. There's probably something obvious wrong with it that I could fix and get this thing sold. And let's say you did, you want a higher R squared. So let's say you add one more thing in. You ask these last 2 questions, you get your R squared up to 98%. Has anyone ever been murdered in the house, and is the house haunted? And now when you add those last 2 things, the value drops down to $80 per square foot. So now you know something bad's happened in the house. So do you care? Now our house is haunted. There's a lady on Helotes. I thought she was joking. At Helotes, I ride my bike there every single day. So they invite me to their Christmas parties. And she was talking about her house being haunted. I thought she was joking, but I hope she doesn't watch this video, but she was a great storyteller. So it was pretty funny to listen to her because of her story. But I was like, you probably don't want to say that too loudly if you don't ever sell your house. But she said it was haunted. Mirrors were cracking and falling off and all this kind of stuff. You might say, I don't care if a house is haunted. I don't believe in ghosts. I don't care if anyone was murdered there. And I'm going to live here the next 30 years, so I don't care. But what if you're going to buy this house and you're going to flip it in 3 years? Would you care then? You don't care if it's haunted, but the next person buying it from you might. And that's true. And we'll talk about the models that Investment Society builds. You might get a high R squared on stuff that you don't care about. I don't think that's important, but the market thinks it's important. The market thinks it's important. You don't, but you're a Warren Buffett investor and you're investing for the long term. Yes, I'm going to buy the stock. It's a good stock. I don't care that the market doesn't care about these things. I care about them. So your horizon it makes a big difference when you have these factors that the market thinks important, but you don't think is important. I actually found a video. I was thinking about showing it to you, but I won't. But actually, it was talking about a house whose value, they couldn't sell this house because it was haunted. So you think I'm making this up, but that was a house people thought was haunted. It was this really, really nice luxury home. They couldn't get it sold. They kept dropping the price, and I'm like tempted to go find it and buy it. So it sounds like, wow, that'd be a good deal. You'd probably be a little nervous the first 3 nights, right? You have your radio up full of blast and all that. You know, you say, I don't believe in it, but you're still like, but something's going on here. There's probably some guy living in the attic that's causing all this. He wants people out, you know, something like that. So your horizon is important on relative value analysis. The key is you need to say what's important to you when you do the first valuation. Then you get your R squared as high as you can on the next valuation, so you can see what the market thinks important. So you can see what are they putting into this analysis. That's where you earn your keep as a security analyst. I had one security analyst speak to my security analysis class. He was talking about Apple. And he said, Apple's underpriced because the market is so focused on their margins. And I think they're focused on the wrong thing. Apple's margins are going to be fine. So that's good. So he could tell, I mean, that's excellent. He can say Apple's cheap and this is where the market has it wrong. If you can tell your boss that, they're going to love it. But he had one other thing he needed. What else do you think your boss wants to hear? The market's wrong because of this. And what's that third thing? You don't know the word catalyst? You ever heard the word catalyst? What's the catalyst for the market to become as smart as you are? And he had the catalyst. The market's assuming Apple's margin is going to shrink. I don't think they're going to shrink if you see what's going on with Samsung. And the market is going to see my side of the story in just 2 more earnings releases. 2 earnings releases, they're going to see that these margins are coming back strong. So he only needed 6 months for his idea to be recognized by the market. Your boss will love that. As long as your analysis is good. Now you could be wrong, but that's what your boss is looking at. If you want to be a good security analysis, you got to say why the market's wrong and when they're going to figure it out. If you can do that, your boss will give you high bonuses, because you get paid as security analysts, not just for having good ideas. You have to have good ideas that are executed. Your boss has to implement them. And that's when you get paid the big bonuses. All right. So we're ignoring whether the housing market is cheap or rich. We're just asking, is this house cheap or rich relative to other houses I can buy? And we're adjusting it for value things and risk things. Value things, the size of the house, the quality of the house, the age of the house, and risk things. Is there a foundation issue? How far away is the fire station? Those type of things. So good relative value analysis takes the correct price relative and makes sure it's looking at key fundamentals, key risk factors, using generic analysis, but getting as specific to your industry as you possibly can. So all 3 have to be available: your price, your valuation, your fundamentals, and your risk. Essentially, what we're going to do is use the fundamentals and the risk to predict the valuation. So firms with strong fundamentals and low risk should be expensive. Firms with weak fundamentals and high risk should be expensive. We're going to forecast that out and see if that's the case. And I'll show you how you can build a model to do that. And I have plenty of YouTube videos that show you how to build those models. So fundamental values and your risk factors, fundamental factors, risk factors, those are your independent variables. And then your forecast of the relative value is your dependent variable. So you can say, based on these fundamentals, these risk factors, my PE ratio should be 21. The actual PE ratio is 15. This stock is cheap. All right, so we'll look at some of those. Higher fundamental values should give you higher values. Higher risk factors should give you lower values. Now this, I would carry this around with you in your wallet. I think this is so critical. There's so much finance in this one ratio right here. So you've already seen this. The value of a stock is the dividend divided by KE over G. That's that Gordon growth model. All right. What is a dividend? Well, a dividend is your earnings per share times your payout. That's what a dividend is. What's KE? That's your risk-free rate plus beta times the market risk premium minus growth. So price equals earnings per share times payout divided by the risk-free rate plus beta times the market risk premium minus G. What happens if we divide both sides by earnings per share? We get that the price to earnings, which is the PE ratio, equals the payout divided by the risk-free rate plus the beta times market risk premium minus growth. There's a massive amount of finance in that one little formula. Now I'm giving you the PE ratio. If you listen to Damodaran, his book on the little book of valuation, he does this not just for the PE ratio. He does EV to sales, price to book. He does other ratios and what they're telling you, but this one tells you a lot. So let's start with the risk-free rate, interest rates. This is in the denominator. If you reduce the denominator, what happens to the PE ratio? If we reduce interest rates, what does the PE ratio do? Should go up. Are PE ratios higher when interest rates are lower? Absolutely. So 1980, interest rates were like 15%. Is that a high interest rate or low interest rate? 10-year treasury, 15%? Pretty high. What were PE ratios in 1980? They were like 8 or 9. That's a really low PE ratio. When interest rates are high, PE ratios are low. Interest rates are low, PE ratios are high. And even better relationship is inflation. When inflation is high, PE ratios are low. When inflation is low, PE ratios are high. All right, I would keep that in mind. That applies to all stocks, not just to your stock. All right. So right now, well, a few years ago, interest rates were really low. People were saying our stock's overvalued. When you adjust stock valuations to interest rates, they really weren't all that expensive. You expected their PE ratios to be like 22, 23. One thing Credit Suisse used to say, I'll give you theirs. I stole this from them. But they say PE ratio, S&P 100. You take the PE ratio plus core inflation, that should be less than or equal to 22. So their argument is if the PE ratio on the S&P 500 plus core inflation right now is like 3.6%. You take the PE ratio on the S&P 500 plus core inflation, if that's above 22, stocks are expensive. So what have they done? They take the PE ratio and adjusted it for that inflation or the interest rate. Now, right now, stocks look really expensive when you do that. But that's their argument. Now, I saw that years ago. I don't know if they've updated it. You can certainly look at it. I have done regressions of the PE ratio to inflation, and stocks do look expensive right now. Not as expensive in the 2000 crash, the dot-com bubble. Not that expensive. They do look expensive. They are a little expensive right now. But there are people who do closely watch that inflation, which is highly correlated to the interest rates. What about the market risk premium? If risk is high, that number is high, what are PE ratios going to do? They're going to drop. If everybody's suddenly worried about risk, what are PE ratios going to do? They're going to drop because prices are going to just drop. How do you measure the market risk premium? Probably the easiest way to get that is the VIX. Y'all have seen the VIX, right? What did the VIX do after the election? Did we talk about that? There's the election. Why did the VIX fall? Uncertainty was reduced. They now know who the next president is, less uncertainty. It doesn't mean that they think things are going to be more stable going forward. It's just now we know an important input. The same thing happens on the employment report. Once the employment report comes out, the VIX drops. Now prices might fall as well because they don't like how the employment report came out, but the VIX itself falls. So you've got two things going on here, which is really, really important. When things get risky, what do you think people's growth rate assumptions do? If you're solely worried about a recession, risk goes up. What does your expected growth do? It comes down. What do stock prices do? They nosedive. Your PE ratios come down because, boy, the stocks are just crashing. So high risk, especially when you start expecting a recession, you're going to see stocks fall because the market risk premium is going to go up. Expected growth is going to come down. See, we're subtracting growth, right? So all three of these, when they're higher, will make a lower PE ratio. Growth is the opposite way. When it's higher, it makes PE ratios go higher. All right, so risk-free rate, market risk premium, that applies to all stocks. When interest rates are high, PE ratios are low. When risk is high, PE ratios are low. The next three components, payout, beta, and growth, are related to your specific stock. So beta has to do with the risk of your company. Your company is risky. What kind of PE ratio should it have? It should have a very low PE ratio. All right.
What sectors are good for comparing PE ratios?
Well, you can compare Walmart to NVIDIA if you want to, as long as you adjust for beta and growth. That's the whole key for this. You can compare any two stocks as long as you adjust. You don't have to adjust risk-free rate or market risk premium because that's the same for everybody. So as long as, Walmart has a really high beta. Why does Walmart have a high beta? Is they high growth or low risk? Low risk. NVIDIA has a high PE ratio. Are they low risk or high growth? Probably high growth. They could be low risk, but probably high growth. So can you compare those two stocks? Sure. Once you adjust for beta and growth. So Macy's, well, I don't know if I can even do Macy's. I'm not sure they even have one. We'll see. I think they actually did pretty well here recently. Their PE ratio is 23, so it's actually come back roaring back 23 because something happened when they were a rumor to be a takeover candidate. Something happened the last Yeah, maybe it was right there. Their stock just went wild. PE ratio of 23. You can compare them to Nordstrom's. I can remember Nordstrom's JWN, right? I don't know why I guess the N is Nordstrom's. Their PE ratio is 13. So who's more expensive? Macy's is more expensive. That doesn't make a lot of sense. Nordstrom's is definitely the better company. Is Nordstrom just a lot lower risk than is Macy's just a lot lower risk than Nordstrom's? Probably not. And what's the problem with Macy's? Their main business model is what? They're a hub for malls. Y'all never go to malls. My generation, that's all we did was go to malls. That was our whole life. To get away from our families, we went to the mall. We just sat there and did nothing in the mall all day. It's kind of boring. But we didn't have iPhones, we didn't have internet, we didn't have anything else. So we went to the mall and just sat around. But now being a mall hub doesn't make sense. Nordstrom's has a pretty good online focus. They've got a kind of nice little extra lower price, the rack, whatever thing's called. So it doesn't make a lot of sense, but that's the analysis you're looking at. Why is Nordstrom's PE ratio so much lower than Macy's? It's got to have something to do with either their beta or their growth. Either Macy's is much lower risk or much higher growth. So we've covered everything in here except for payout. And finance ignores payout. And we talked about this for paper 4. Does anybody remember why are we ignoring payout? What do we say when we pay out more of our earnings? What happens to the firm? If you retain more, the firm does what? Grows faster. If we pay out more, what happens? They grow more slowly. In finance, we assume if you increase the payout, you reduce the growth, and those two offset each other. So you can ignore payout. All right, so that's kind of nice. So this tells you everything you need to know about it. Two stocks. If one has a high PE, one has a low PE, it's either beta or growth. And you got to figure out which of those two it is. It's going on with the company. I'm kind of tempted now to go out and short Macy's and buy Nordstrom. I mean, look at Nordstrom's 13 PE. Walmart's probably in the upper 20s right now. I don't know. I haven't looked at Walmart in a while. Wow, 45. Look at that. Walmart is just off the charts. That is way too high for Walmart. 45. This is crazy. Walmart has been in the 20s. Suddenly they're in 45s. Well, Walmart has had a great last year. Their earnings are much higher, but their stock price is even more, gone up even more. So yeah, I mean, Walmart is definitely doing some exciting things, but not that exciting. Why is Walmart worth 3-4 times more than Nordstrom's? Their beta is definitely low, right? 0.52. I'm going to cheat and use the Bloomberg one. 0.52 versus 2.6 for Nordstrom's. So definitely much lower beta. So that's going to make their PE higher. But growth, yeah, I would probably think Walmart probably could have higher growth than Nordstrom's. I don't know. I don't shop at Nordstrom's more. So anyway, that's the type of analysis you have, and it's all in this formula. If you remember this formula, you won't make the bad mistakes people make with relative value and forget to adjust for risk. Say, wow, this firm is really, really cheap. And you buy it and you discover that they had a massive amount of debt and you didn't adjust for risk. And now you got this stock that you thought was cheap and is actually quite expensive because you didn't adjust for risk. All right, so great formula. I would remember this formula, but it's really easy to remember because it comes right out of the Gordon growth model. All right, so these are old numbers. So I won't use them, especially Walmart. Look at that, 29, now it's 45. Kroger's PE ratio is really low. So Kroger's, is their PE ratio low because they're high risk? What kind of beta would a Kroger have? Low beta except for what? Kroger has really high debt. So it's hard to say. Probably low growth because Kroger's is really, really struggling. Tesla, why is Tesla's PE ratio so high? Is it low beta or high growth? Probably high growth. Amazon, probably high growth, you would think. So are they cheap? Are they rich? Are they slow growth, high growth? Are they high risk, low risk? Some combination. That's what relative value is trying to tell you. You don't just go out and buy Kroger's and short Tesla without making these adjustments. I don't know anyone that your only thing you look at is PE ratios, and that's going to give you a good stock selection because PE ratios have a lot embedded in them. All right, so look at our numerators and denominators. Our numerators are current price, enterprise value. Current price is just the value of the stock. It can be the price itself, or it could be the market cap of the firm. Enterprise value is the value of the firm plus its outstanding debt minus its cash. That's enterprise value. It's stock value plus debt value minus cash. Most firms, 99% of firms, the enterprise value will be greater than the price and the market cap. Some firms is actually lower, like a firm like Apple, if they have more cash than debt, it's possible enterprise value to be lower than the market value. That's enterprise value. So get this in your notes. I want everybody to make 100 on this part of the exam. I don't think you will because no one ever has. It never has worked that way. But current price only involves the stockholders. Enterprise value includes stockholders and bondholders. So on the exam, when I give you a relative, you got to make sure that's matched up. If I give you a price, it's got to be price of something that only belongs to stockholders. If it's enterprise value, it's got to be divided by something that belongs to both stockholders and bondholders. What belongs to the bondholders? Debt. And how do they get their debt back? What do we give them? Interest. All right, so debt and interest belong to the bondholders. What does EBIT stand for? Before interest. All right, I've heard students say earnings for income tax. That's not right. It's earnings for interest and taxes. So who owns EBIT? Stockholders or stockholders and bondholders? Both of them do, right? You haven't paid your bondholders yet. So EBIT is both stockholders and bondholders. So what would be the correct ratio? Price to EBIT or enterprise value to EBIT? Be enterprise value to EBIT. Anything that's before interest expense has to be enterprise value. How about EBITDA? What would you use there? Someone yell it out. Make sure you're with me. Price or enterprise value? Who owns EBITDA? Enterprise value. It's before interest again. What about earnings per share? Who owns that? Stockholders. So what do you do there? Price to earnings, PE ratio. There's your PE ratio. Price to EPS. Earnings per share is after interest expense. So you use price to EPS. The book value of the firm, that's assets minus liabilities. Assets minus debt. What is book value? Who owns the book value of the firm? Stockholders or stockholders and bondholders? Just stockholders. So is it price to book or enterprise value of the book? Price to book. That belongs entirely to the stockholders. Revenue. Is revenue before interest expense or after interest expense? Before. Who owns revenue? Both. So what is it? Enterprise value of the revenue or price to revenue? EV of the revenue. What's the only one Yahoo Finance gets wrong? And they don't show it to us anymore. Of course, oh, here it is. Let's see if they'll show it to us. What's the one they get wrong? They got PE ratio. Is that okay? Enterprise value to EBITDA. Is that one okay? What about enterprise value of revenue? That's okay. Price to book? Yes or no? Think about it. Price to book. Book value belongs to whom? Stockholders. Price to book's okay. What about price to sales? Sales belongs to whom? Both. So does that look right? That one's wrong. If you go out and buy companies based on price of sales and you buy the cheapest one, you're going to put a bunch of stocks with heavy, heavy debt loads. And that's probably not what you want. They're not cheap. It's just you use price. If you do EV, what do? You take price and you add all that debt back. Now they don't look all that cheap. Well, you're trying to get valuation down and you have firms whose earnings is negative. So revenue is about the only thing you have left to use. or you have EBITDA. EBITDA is greater than earnings. So if you only have price to earnings, and you have firm with a lot of negative earnings, then you have no way to do a relative value. But it's more than that. Revenue, okay, we have to stop there. We'll get into this more next class, but yeah, all right, so I'll stop it there. You should have gotten something about the instructor and course survey. Have y'all seen that? So if you do that, I add 1% to your overall grade, so it's a freebie. Interesting thing is there's a high correlation between students who desperately need the 1%. They're more likely not to do the survey than the students who don't need the 1%. They're more likely to do it. Y'all can explain that to me. Doesn't make sense, but anyway, I'll put that in the weekly email. We're going to finish up relative value, talk a little bit about portfolio management. And then next class, we'll probably be getting into options. It's a really fun topic. Tuesday, I know next week's a holiday, but next Tuesday is a regular class. We'll do a team question on the stock valuation. So really just have 3 more team questions: stock valuation, this relative value that we'll talk about today, and then we have an option question. So you got 3 left. The stocks is probably the highest score on the exam. Most students can plug numbers into formulas. The options used to be a weak answer, but students have gotten much better at that. So that one will probably be better, but the relative value continues to be the worst answer on the exam for some strange reasons. We'll try to get into that. Before we do that, since Elizabeth is here, have y'all seen this article? Am I embarrassing you, Elizabeth? So good job. Where are you gonna be working, Elizabeth? New York, Dallas? Dallas. Oh, we've got some. If you email me when you get up there, we have some alums. Elizabeth. I can't remember his nickname, but we got a couple up in that Dallas area. I had a reunion with them a couple years ago, and they were all meeting each other for the first time. And they all work for Goldman Sachs. So yeah, that's a great job. Well, congratulations. That's really good. I didn't read the article yet, so I have to get in there and read it. That's a good article. All right, let's talk about relative value here. So last time we said you got to make sure you match up your numerators to your denominators. The numerator is either only to the stockholders, that's price or market cap, or your numerator includes both stockholders and bondholders. That's enterprise value, which is the capital market cap of the firm, how much it's worth to stockholders, plus the debt, and usually minus the cash. So if you're going to have a numerator that's only for the stockholders, you make sure you have a denominator that's only for the stockholders. This is the whole essence of the exam question. So price can go with earnings per share and book value. Enterprise value goes with EBIT, anything that's BI, EBIT, EBITDA, and revenue. All of those are before interest expense. So you have price to earnings, price to book. You have EV to EBIT, EV to EBITDA, and EV to revenue. All right. On the exam, and you'll see it when we do the team question. I'll give you several of them, and you have 2 questions to ask, or a few questions that you have to say which ratios would you throw out and why. So if I give you price to revenue, say that one's not a good ratio because price is stockholders, revenues is both stockholders and bondholders. Not a good ratio. If I give you enterprise value to book value, say that's wrong. Enterprise value is stockholders and bondholders. Book value only belongs to the stockholders. And then the second question you have to answer is which ratio belongs to the stock you're looking at? Is it technology? Is it materials? Is it industrial? Is it consumer? So then we have to decide which ratio. So we'll talk about that next. But you have to be able to answer this question. So y'all write these down. Let's see if you can get 100% because I want you to get 100% on exam. I know you have professors that want you to fail their exams. I know you have those professors. I remember a professor that bragged about how low the grade was on his exams, like it was a good thing. And I'm thinking, well, you must be a really horrible professor. He's thinking I'm a really great professor. I want you to ace my exams, but I'm not going to make it easy for you. Huh?
You think it's an ego thing?
I don't know. To me, it's bad ego. If your students can't pass your exams, you must not have taught it very well. So it seems like a bad ego thing, but I don't. Do you have professors that brag? I had one graduate student professor. He bragged about how hard his exams was, and then his exam was really easy. So he counted off for not using complete sentences. It's a finance exam. I didn't say the net present value is, I just said MPV equals. So he took off points. I made a mistake of telling him, well, he said I had to do that because the grades were too high. I said, well, just make your exam more difficult. That made him so mad. And so on the final, he put the multi-stage dividend discount model on the final and didn't tell anybody, but I knew he's going to do it because I could tell he's mad. So I was the only one ready for it. But oh, he made the whole class. I didn't tell the class. That's the reason I was on the exam. But yeah, but he bragged about having really hard exams, and then his exams are really quite easy. I want my exams to be easy, not because the material easy, is because you're finance majors and you know this stuff. So let's try it. All right, I'll give you a few. Y'all can write these down. I just want you to say good or bad, right? That's all you got to do. G or B. It's a good ratio or is a bad ratio. All right, y'all ready? You don't have them all, do it right what we're talking about. Price to earnings, is that good or bad? It's good. Price to earnings per share? Good, it's the same thing. Right? Earnings per share is earnings. All right, we could do it. This is the same thing as market cap to net income. It's the same thing. You can do it on a per share basis. This is on a per share basis, or you can do it in total. Market cap is the stock price times the stock outstanding, and net income is, so these are, 5 billion versus 400 million. Price is the price of the stock to earnings per share, but that's fine. What about EV, the book value? Bad, yeah. Book value belongs to stockholders. EV of the EBITDA, good. EV the sales, was good. All right. I'm hearing one person who's not even in this class. So everybody else getting it? I know he's got it. EV the EPS, bad. Price to book. Price to book is bad. Anybody disagree? Anybody argue that it's good? Who owns price? Stockholders or stockholders and bondholders? Who owns the book value? Stockholders. That's a good one. Yeah. What about EV the revenue? Same thing as EV the sales. You notice in Yahoo Finance, not only they have it wrong, but they for some reason shift it around. Not sure exactly why they do that. Let's see how Nvidia is doing today. I think they were kind of flat today, up 1%. They were down quite a bit last night. So they've got price of sales, but then they do EV the revenue. Why did they do that? They even changed the word from sales to revenue, as if they're two different ratios. So this ratio you would never use. Price to book is fine. Enterprise EV to revenue is fine. EV to EBITDA is fine. Price to earnings. And trailing versus forward. I had a guy I worked with at UTSA. He always used the forward PE because it's always lower. And he was head of equities. This is before I took his place when he retired. But he used the forward because it's always lower because it's your next earnings. And he wanted to make stocks look cheap. And he would cheat sometimes and compare the forward earning to historical trailing. Well, you can't do that. Those are two different numbers. So don't pick your PE ratio based on what makes your story. Make sure you're being honest about it. So the forward PE will always be lower, or most firms will be lower than the trailing. Don't say, well, Nvidia is trading at 57. Oh, no, they're not that expensive. They're only trading at 37. Well, depends. Obviously, you're expecting earnings to be much higher in the future. So when you do a forward PE, you're going to get a much lower PE ratio. So be careful. I have a great article talks about how PE ratios is one of the best ways we lie in finance because we can pick the one that makes our case. A lot of people like to use EV to EBITDA because it's a lower number than price to earnings. Why? Because EBITDA is going to be higher than earnings. But that doesn't mean the stock's cheaper. It's just a different way to measure it. So don't pick your PE ratio. Don't pick your relative that best makes your case. But a lot of people do that because, this is high for this firm, but if I found a more normal firm, let's do a JWN, a more normal firm, and their price to earnings is 12, but their EV to EBITDA is only 5. Well, what the Motorman talks about this, so he'll say, stock analysts, they'll talk about EV to EBITDA with their boss, because a typical stock's price earnings might be 20, but their EV to EBITDA might only be 8 or 9. Their boss knows they're two different numbers, but 8 or 9 just sounds cheaper than 20. And they don't make the adjustment in their mind. So this analyst knows that, hey, the EV of the is only 8. The boss goes, oh, that's a cheap stock. Well, no, their price to earnings is 20. So, don't pick your ratio based on what sells. Make sure you're being honest on this. But you can stop and manipulate this. Always see price to sales is going to be the cheapest. I mean, EV to sales, excuse me, is going to be the lowest. But that doesn't mean that the stock is cheap. Now, there are some places where I'm going to show you why I don't own Costco stock. I love Costco. I think it's a wonderful company. I love the fact that they pay their employees so well. They treat their employees really well. They treat their customers really well. I love when their CEO says their goal is to make as little money as possible. This is a firm that understands why they exist and what they do. But let's think about EV, the revenues. What kind of margins does Costco have? Wide margins or narrow margins? Very narrow margins. So if a firm has narrow margins, should you be willing to pay more for $1 of revenue or less than for $1 of revenue? Much less. You saw Nordstrom's was like 50 cents. You pay 50 cents for $1 of revenue. Look at Costco. It's $1.60. You're paying $1.60 for $1 revenue when 97% of that revenue is going to get eaten up in expenses. That is an expensive stock. I mean, look at their PE ratio. It's 56. This is an expensive stock. So I think it's a wonderful company, but so does everybody else. So one question I always asked in interviews was define a good company and define a good stock. Costco is a good company and a bad stock, in my opinion. NVIDIA is a good company and a decent stock. Walmart is a good company and a bad stock. I think Walmart's overvalued. Their EV, the revenue is 112. That's just too expensive. Their PE ratio is 35. That's too expensive for Walmart.
What is the book value?
The book value is just their assets minus their liabilities. So you can do book value. Book value is, if you go to financials, it's just their net worth. So that's their book value, 90 billion. Or you can do it on book value per share. So you'll see book value you can do price, the book value per share, or you just do market cap over the net worth of the firm. All right. So when do we use which one, Tristan?
Your book value to
Well, that's what price the book is. So if you think about it, so most of my career, let's do JP Morgan. Most of my career, so JP Morgan has an accounting book value, the GAAP accounting, and they have a market value. Which do you think would be higher? What the accountants think it's worth or what the stockholders think it's worth? And how much more? Would you pay 50% more than what accountants think, 100% more? What would you think? Well, JP Morgan's kind of normal now. My whole career, up until the 2008 crisis, banks traded at 2-to-1 price to book. You'd be willing to pay twice as much for the bank as the accountants thought. And JP Morgan's somewhat back there now. JP Morgan's price to book is 209. But that's not every bank. You look at Citibank. Citibank looks like a steal. Their price to book is 67 cents. That means you can buy, you remember accounting is supposed to be conservative. I don't know if I remember that from your accounting class. It's supposed to be conservative. And yet you can buy Citibank at a 33% discount to what the accountants say it's worth. If you go back to, well, look at this. They were 58% cheap to what the accountants thought. If you go back to the 2008 crisis, they got down to like 80% cheap to what the accountants said. And all banks were trading below 1. So the 2008 crisis brought them down. So I was used to a 2-to-1, and then suddenly the 2008 crisis, they're all falling below 1. Now JP Morgan's back to 2-to-1, back to normal, but not necessarily looking at expenses versus history. And price to book, I'll explain it. Price to book is what you use for banks. You don't use price to EV to revenue or enterprise value to revenue. So price to book is the most common one. What do y'all think about a local bank like Cullen Frost? Do you think it's an expensive bank or a cheap bank? JP Morgan was 2. Do you think Frost is more valuable than than JP Morgan or less?
Less.
You think less, or it might be surprised? Colin Frost Bright's book is 221. Why is Frost so valuable? Anybody know? There's one statistic they have that dominates it.
Like more room to grow.
But grow where? So what exactly do they have? They have something Goldman Sachs, Elizabeth, Goldman Sachs would love to buy Frost Bank. What does Frost have that they would love to get their hands on? What does Goldman Sachs need more than anything else? They used to be an investment bank. Now they want to be a commercial bank or be a regular bank.
Data.
So how do you get consumers? What's the biggest thing consumers give you that's really cheap? They give you deposits. Right? Colin Frost, they have savings accounts that pay what, 1%? Do you think someone would like to borrow it? Well, you think they're borrowing 1% from the bond market? Why do they get such cheap? Because the federal government's guaranteeing their deposits at the FDIC. They get to borrow on the cheap. So what the one ratio Frost has is their loan to deposit ratio. It's very low. That's how they have room to grow. They can do a lot of loans because their loan deposit's really low. Goldman Sachs is desperate for deposits. That's why they have those special deposit accounts that they think they try to do something with Apple. They need a deposit because investment banks don't normally have depositors. And now they want to be a normal bank. So they would love to buy a Frost and get these massive deposits. So Frost is a really, really good bank. They've been talked about as a buyout candidate for that very reason. You get a bank with a lot of deposits, but not many loans. Well, you buy that bank, you can start loaning like crazy and make a fortune. So Frost is a very, very conservative bank, very well run bank, and doesn't really chase growth. And they could get much, much larger. But yeah, an impressive bank right here locally. So, all right. That brings up our next question. So you got the first one down. Any questions on these? Price to book, is that okay?
Yes.
That's good. All right. What's a good price to book for a bank? 2 is pretty normal. What about for tech stock? For tech stock, just forget it. 54. Why? Because no one cares about the book value of tech stocks because they don't have assets, right? What is NVIDIA's most important asset? It's not on their balance sheet. What is their most important asset? Their employees. What do accountants say employees are worth? 0. They're an expense. So their most important asset is not even on their balance sheet. So their price to book doesn't make sense. But for a bank, yeah, their assets are all there. That's what they are. You can see it. So price to book means nothing for but what about for a utility? Price to book makes a lot of sense for a utility. Their price to book is 182, much more normal looking, right? So it's really important which of these ratios you use. So that's the next part we got to get, and that's the next question on the exam is which. So I'll give you a company, and which relative would you use? So we have earnings-based relatives, price to earnings, EV to EBIT, EV to EBITDA, and the PEG ratio. PEG ratio is just the PE ratio divided by expected growth. You got a book value relative, price to book, or if you have a firm like Starbucks, McDonald's, Boeing that have negative net worth, so you can't do a price to book value, you can do a price to multi-year. I checked on Bloomberg. Bloomberg does give you a price to 10 years of earnings. So if you're trying to look at Starbucks right now and you can't do a price to book, you wouldn't want to do a price to book for Starbucks. But if you want to get it, you could get their price to 10 years of earnings. That is a relative you can use. And the last one, revenue base, EV to sales, EV to revenue. That's a pretty popular one. So when do you use which ratios? So off the bat, price to earnings works for everybody. You can use price to book, price to earnings for every industry. But there's some industries that these ratios are more appropriate for than for other industries. So here it is. You need this for the exam. Make sure you have this page ready to go. This entire PowerPoint is on Canvas. So earnings base work for everybody, price earnings, but technology stocks are really focused on EV to EBITDA more than anything else. So if you're talking about a tech stock, you'd want to bring up their EV to EBITDA. It's just the most logical thing to start with. So firms really focus on growth, on earnings growth, Earnings-based relatives are the most important. Let's jump down to revenue base. That's pretty simple. Revenue base, that's all those companies that are focused on margin, all your retail companies. So Walmart, Costco, Nordstrom's, any retail consumer type of bank or institute outlet that is focused on margins, grocery stores, Kroger's, you're going to use EV, the revenues. Pretty obvious. It's kind of, I've never seen that one not be the case, but well, maybe once, but it's pretty rare. Now, book value gets a little more tricky. There are places where book value makes a lot of sense. So firms that have massive, massive capital requirements. So I just mentioned Duke, the utility. We look at Duke, go to their financials, and look at their balance sheet. Look at their property, plant, and equipment. It's 116 billion of their 176 billion. When you see that, when you see a firm with really large property, plant, and equipment, you're probably going to use price to book. So property, plant, and equipment is more than, say, 40% of their assets. Price to book might be a good ratio to use. You could probably say the same thing for Intel. Intel has $96 billion, so it's over a third of their assets. Why? Because they build those massive fabrication plants that are pretty expensive, you know, $5 billion plants. So I realize Intel is a tech company, but they're a tech company with high property, plant, equipment. You can get away with an EV to EBITDA and a price to book for Intel. But what about NVIDIA? Their PP&E is 5 billion out of 66 billion. It's not even 10 billion, 10%. So you would not, you see a firm like that where their property, plant, equipment's not even 10% of their assets, you would not use price to book for a firm like that. All right. So firms that have high capital requirements, a lot, and just put it in your notes, high property, plant, and equipment as percent of assets, use price to book. The second group are cyclical commodity-based companies like energy and materials. Firms whose net income goes up and down with commodity prices like oil prices or steel prices. It's really dangerous to use earnings base because Exxon looks really cheap when oil prices are high and they look really expensive when oil prices are low. Why? Because the oil market knows prices are going to fluctuate. So at the end of 2022, Exxon looked really cheap because oil prices are really high. But they really weren't cheap. It's just the market knew oil prices were going to fall and they didn't want to overvalue the stock. Back in 2020, Exxon looked really expensive. Why? Because oil prices were low, their earnings were low. How do you get around that? Where you use price to book, so you're not looking at just 1 year of earnings. This is a perfect industry to use price to 10 years of earnings. So you get through all those cycles. So price to 10 years of earnings would be really strong. So Exxon, all of the big steel companies, Chevron, those type of firms, price to book would be the most likely thing for you to use. And then industries that are always talking about return on invested capital, banks, insurance companies, real estate companies, price to book is what you're going to use there. Banks, insurance companies always use price to book. That's just the go-to. Even investment firms is more EV, the assets under management, but that's similar to a price to book. So those are the common approaches. So technology-based companies, high growth companies, EV to EBITDA, high property, plant, and equipment, you can use price to book. Commodity, cyclically based companies use price to book. Financials use price to book. Anybody focused on margins, retailers use EV to sales. All right, so let's test this one out. Costco, what are you going to look at for Costco? Someone throw it out. Get it out. PE ratio, we use PE ratio? Yeah, we use PE ratio for everybody, but not the best one. So on the exam, be careful of that. When you get PE ratio, Don't say this is not appropriate. You can say PE ratio is appropriate for all companies, but there's a better, more important one for Costco. All right. So we use PE for everybody. PEG ratio, would that work for them? You could, but it wouldn't be that normal. Price to sales. That's a bad ratio, so you don't do that. Price to book. Anybody want to argue price to book for Costco? How would we check that out? How much property, plant, and equipment they have. They probably have some because of all the stores they own, but that's not the most important one. So what would you use for them? EV to revenue. Retail firm, EV to revenue. That's where they look really expensive. $1.60 is really expensive for Costco. If Costco gets cheap, I'd probably buy it unless there's something major happened to them that caused them to go cheap. Let's do F5. F5 provides multi-cloud application security and delivery services. What does that sound like? So what ratio would you use for them? EV to EBITDA. They're trading at 17. You notice that seems cheap, but try not to think of EV to EBITDA as the same thing as a PE ratio. PE ratios can be 25, 30, 40. EV to EBITDA is usually 10 to 15 to 20. They are fairly cheap, actually, though. For a tech company, their PE ratio is only 25. So PE ratio, that's fine. That's good. You're probably more likely to use the EV to EBITDA, but PE ratio would be perfectly fine for a tech company. PEG ratio would work really well for a tech company. Their PEG ratio is a little bit high, but not screaming high. 1.41 is not a bad PEG ratio. COP. Where'd it go? Conoco. What would you use for Conoco? Price to book, why would that be? So what kind of firm is Conoco? Oil company, essentially, right? So energy, yeah, price to book would be the most normal there. You can see firms that should use price to book, you'll probably get a normal price to book. So you look at a tech company, you got like a 10 or 50 or whatever. I think, some firms, yeah, Tesla's an interesting one, isn't it? You might say price to book for Tesla, but they are a manufacturer. They do have a lot of property, plant, equipment. They're kind of a unusual firm. Are they a tech company or are they a auto manufacturer? So they're a little tough. Most people, well, none of the ratios look good. Their PE ratio is 93. Their price to book's 15. You got to pay $15 for $1 what the accountant thinks it's worth. Your EV to revenue, should be like 1 or 2 is 11. EV to EBITDA is 77. That's high even if it's a PE ratio. So none of their ratios make sense. But a firm like Conoco, yeah, your price to book, you get a normal looking number on price to book. So Tesla's the kind of the exception. It doesn't really work there. Macy's, what would you use for Macy's? Which one?
Revenue.
The revenue. Enterprise revenue. You notice a difference between them and Costco? Who has the wider margins? Macy's or Costco? Macy's used to be willing to pay a whole lot more for $1 revenue at Macy's than at Costco, and yet Costco is 4 times more expensive. Doesn't make sense to me. Just it's crazy. I realize Macy's is in a lot of trouble because they're in malls and all that, and malls are dying, so it is a dying company. Their PE ratio is pretty high though, 22. They've come back pretty strong. Let's see. Man, is it doing that? US Steel, I can't get it. Let's do, I'm trying to think of the steel company. I can't remember the name of it, but what a steel company, what would you use? I'm trying to think it. Why can't I remember? Oh, there you go, X. There's another one I'm trying to think of, but it can't remember the name of it. So what would you use for a steel company? Commodity based. Price to book, definitely. And their price to book almost looks normal, doesn't it? It's a little cheap, but it almost looks normal. PE ratio, you can use that. Remember, PE ratio, you can use that if you want to. I don't know anybody use EV to EBITDA for a steel company. I guess you could. They look really, really cheap when you do that. What about Capital One? What would you use for Capital One? Book value, price to book. How are they trading? A little above one. Look pretty cheap. If USA were to sell off its bank, they would probably look at Capital One and Frost price to book. Probably they could sell that bank for 1.5 times book value.
Is that for all financial?
Investment firms is a little bit different, but banks, insurance companies, real estate companies, price to book is definitely the go-to. But at a firm like BlackRock, you can use price to book. It doesn't really look at their price book. So do y'all know what assets under management are? And that's all the assets. So usually for a BlackRock, you'll do enterprise value of the assets under management. Because that's really the key is how much you're paying for how much, because that's the key to their revenue is how much they have in assets because they charge management fees. So when USA sold its investment arm over to Victory Capital, that's what I looked at. I looked at enterprise value to assets under management. And I didn't think they got a good price for that based on that. I thought they could have gotten a better price than they did. They kind of a little bit of a giveaway. But you don't see enterprise value the assets under management here because it's not on the page anywhere there. So that's kind of a unique one for that industry. There are a few other unique ones for certain industries that we tend to use. What about AT&T? Price to book has been the historical thing to do. We can look at their financials. Their property, plant, equipment, it's sizable. 150 billion out of 400 billion dollars. It's sizable. AT&T Telecom is a little bit tricky. Telecom, AT&T is in the same sector as Meta and Alphabet, which sound like techie type of firms. AT&T with telecom, they're getting in some stuff that's a little techie. So it's pretty interesting. My last time I bought an iPhone, guess where I bought my last iPhone? It was in an AT&T store because it was all cracked and messed up. They had to break into it.
Would you do these ratios depending on like where they get it from? Like AT&T, primarily for my subscribers.
Well, it really does come down to what kind of firm it is. So you take like a Disney, Disney's probably going to be EV to revenue, but they're in several different industries. So there's not a hard and fast. I'll show you how we do it in Investment Society. You can run a regression and let the regression tell you what the market's most focused on, which of these ratios. So we'll normally bring in 4 or 5 ratios and just let the model tell us what best explains what's going on with the firm. The interesting thing with AT&T, do y'all notice this number right here? Goodwill, what does that mean? Huh? Well, brand recognition of whom though? It's not theirs because their brand doesn't go on their balance sheet. So whose brand is this? I mean, that's a good way to state it. That's the brand value of the firms they purchased. That's their mergers and acquisitions. That's their acquisitions. When a firm has half of its assets and goodwill, they've done a lot of acquisitions. And that's, AT&T, they're buying up all these other firms. Yeah, that's a hard firm to really, really assess. So it's kind of your point, Tristan, who all these firms are buying? Are they more techie? Are they more telecom? They're more utilities? Telecom used to be part of utilities, just really another utility, and price to book is what you use, but they are somewhat changing. I mean, I wouldn't use price to book for Meta. What would you use for Meta? Yeah, EBITDA. There's still somewhat of a techie feel to it. So yeah, I would use EBITDA. You look at the price to book, you can tell that's not the right ratio, right? You see a price to book of 8. It's like, okay, price to book's probably not the right answer for this firm. So, all right. So think through this. We'll do a team competition on this probably the Tuesday after the that Thanksgiving break. But not just for the exam, you need to know this. This is one of those things just off the top of your head, you should know which ratio to use.
What about healthcare?
Healthcare, it kind of depends what you mean by healthcare. So if you see Humana, I probably use price to book because it's really more financials than it is. If it's a hospital and they got a lot of hospitals, kind of depends. Some of them are more on the price to book, some of them are on the EV, the EBITDA, I mean, EV, the revenue, depending on the more retail, it kind of depends. Depends on the kind of healthcare they are. Like if you consider CVS to be healthcare, I would probably use EV, the revenue for them, because they're a little more retail-y, but they do a lot of, so it kind of depends. That's why Excel can help you. Excel will tell you which of those best explains what the market's doing, so that can help you a lot. I have seen tech companies, when I run a regression, will go to EV, the revenue. I've seen that here recently going on, where they like EV, the revenue. Banks, it's always price to book, with rare exceptions. Insurance companies price to book. It's just there's some industries, and retail is almost always EV, the revenue. So technology occasionally will kick over into the EV, the revenue side, depending on where people are focused. But price earnings works for all of them, so you can't say price earnings is wrong. It's just there's one that's more appropriate, that's a little bit better. So how can you use these relative value? For screening, I'll show you some screening models here. You could screen for stocks, and I'll show you a few models that we built. I encourage you to build on these models. I have plenty of YouTube videos out there to show you how to do it. It's a pretty easy thing to do. I've built a model in 30 minutes and got a good short list of stocks to look at. It's not that hard to build one. You could use it for bonds. I never did that when I was at USA, but you could with bonds. You could use like CDS spreads, credit ratings, bring in other things like their debt to equity or their margin volatility, those kind of things. So there's stuff you could do. You could do a screening on bonds. It's a little more difficult to get the data out of Bloomberg, but you can. The biggest challenge with bonds is they're not necessarily traded every single day, so you can't always trust the spreads. CDS spreads are a little bit, you may know what a CDS is. So default call, default options or whatever swaps. So they're called swaps, but my brain thinks of them as options, but I guess they really are swaps. But yeah, so you can get their option premium or their future premium, whatever you want to do. But those spreads can tell you the probability. So you can do it with bonds. You just got to get the data. If I were USAA selling off the investment arm or selling off the bank, I would go and see. So USAA, probably the closest bank to USA probably is Capital One. And Capital One was trading at a 1.1 price to book. That's probably where USA would start. They might say, hey, we're faster growing, or we got a better book, or our loan to deposit ratio is lower, or whatever. They would look at some and maybe adjust for that. They could run a model with all these banks and see with all the statistics they have and see wherever they would fit in on the price to book. I don't know if they're going to sell their bank. I'm just trying to start a rumor that they are. That's probably the entity they're most desperately wanting to get rid of because it's their Achilles heel, but they could sell off that bank. It would be interesting. It could determine benchmarks for your company. So one of the projects I had when I was in finance was, it wasn't quite on valuation, but our life insurance company asked me, why are we AA rated? Why aren't we AAA rated? So I went and ran a model just like this, not against valuation, but against credit ratings. And I came back to them, and what I said is, your problem is you're not a large enough insurance company. There are insurance companies with much worse statistics than yours that are AAA rated, but they're 10 times your size. if you want to be AAA rated, you got to be 10 times bigger than you are, because that's what determines ratings. It's like, well, forget it. We're not going to do that. So yeah, I mean, that's the only way you can get AAA rated. They're not going to rate a firm as small as you AAA. So, but you can use that, you can bring in the data. I did that for the USA Property and Casualty Company, where I brought in all these public companies, looking at valuation, what was the market thinking? And I compared USA's data to that to see how we stacked up. Are we a great company? Are we a mediocre company or whatever? You can do that kind of thing. And then it helps you understand what is the market focused in on. They may be focused on things that you're ignoring. And you go, wait, why are they so focused in on this? Why are gross margins so important right now? Oh, because inflation's been high. People, you're worried about margin compression or whatever. You're looking at those kind of things. Or why are they focused on your debt and your interest costs? Oh, because rates are rising. We got the Trump tax law maybe going away, you know, all these kind of things. What does all these mean? So the market may be telling you something, or the market may be wrong, and you see, wow, they're focused on the wrong things. So those kind of things you look at. Let me show you some of these models. They're really easy to build in Bloomberg. So here's one we built for our consumers. Walmart, Target, Kroger, Cisco. We brought in their sales growth, brought in their turnover. We brought in how their turnover improved over 3 years. We brought in their inventory turn. Do you want that number to be higher or lower? Inventory turnover. What's better, a high inventory turn or low inventory turn? High, you want that to be high. Working capital, do you want that to be a high number or a low number? Your accounting classes said high. What does finance say? Low. So I keep wanting someone to tell their accounting professor that I'll debate them in public on working capital, because they've got it exactly wrong. They say a high current ratio is good. Finance says no, current ratios tell you nothing about liquidity. You should throw that ratio. And the thing that bothers me so much, you ask a finance undergrad student to do a financial analysis, and the first thing to do is the current ratio. The one ratio that no one in finance uses, and that's the first ratio to do. What does accounting say? Oh, you should have higher current assets than current liabilities. No, you shouldn't. How liquid is Walmart, do you think? Is that a liquid firm? It's one of the most liquid firms in the entire industry, in the entire market. Very, very liquid firm. Their current liabilities are 92 billion. Their current assets are 76 billion. What did the accountant say? Uh-oh, we got a liquidity problem. What does finance say? No, this is an incredibly liquid firm. Why? Because their inventories are really low. Why are their inventories low? Because they turn them over really fast. Their accounts receivable are really low. Why are their liabilities so high? Because they tell their vendors, we'll pay you when you feel like it. Right? You want to deal with Walmart, we'll buy stuff from you, we'll sell it in our store, and then we'll pay you a month later. Does that sound illiquid or liquid to you? Would you like someone to give you stuff to sell? You don't have to pay them. You sell it, you get all the cash from selling it, and then you pay the vendor a month later. Does that sound liquid or illiquid to you? It sounds really liquid to me, right? I've heard accounting professors say this ratio can sometimes fool you. I know, no, it's always wrong. It never tells you. The fact that some people say, well, Walmart has a current ratio below 1, just they're liquid despite that, and no, they're not liquid despite that ratio. They're liquid, and that ratio is telling you why they're liquid. They have very low inventories relative to their sales, and they don't pay their vendors all that fast. Their vendors have to wait for them to pay them. This is an incredibly liquid firm. So working capital, you actually want that to be low. So we're bringing this in, and we want it to be low. Lower number is good. Gross margins, you want that to be high. Make sure when you're using EV to revenue that you have gross margin in there, because a firm will have a low gross margin, low EV to revenue because they have low gross margins. You have to have that in your model.
For working capital, do you want it to be low, or are you just in your base?
You want inventories and receivables to be low, and you want accounts payables to be high. So inventory, you buy $1 billion in inventory. So Target right now, why did Target fall so much? We talked about that Wednesday, right? They've had this problem twice. Now we're here again. Does that look like their stock price moved? What happened? They missed on earnings, but they also have this massive inventory buildup. They built up inventory because of the port strike. This is the second time in just not too long that they've had a major inventory overbuild. Accountants say, well, oh, that's wonderful. Look at all the inventory. Their current assets are so high. Isn't that good? They're so liquid. Is the stock market saying high inventory is a good? No, they're saying it's a terrible, terrible thing. So yeah, I'm sorry the accountants teach it wrong, but I don't know how to fix it. But if you have an accounting professor that says it's good, you know, say Professor Sweet will debate you in public. All right, so gross margins, you want them to be higher. We look at the growth in EBITDA just to see if net margins are actually growing over time. We look at net margins and the growth in net margins. We then look at return on capital. We look at EVA. If you don't remember EVA, it's a really good measure. You want that to be high as possible. We look at their probability of going default. We look at their debt. I like to bring in volatility and short interest just more out of curiosity. It usually doesn't allocate to these except for tech companies. These can be pretty important to tech companies. You notice I use volatility and not beta. You could use beta as one of your risk measures if you wanted to. The reason I don't like beta and volatility both is that the inputs for those are prices, and we're trying to forecast the price. I don't like to have price in one of the numbers I'm using to forecast price. Makes me a little nervous. Short interest ratio, we know that can fool you if you're doing a firm like GameStop, but anyway, I put it in there. And I brought in price to book and EV the sales, but we know the model is going to allocate. Well, this one actually didn't do it correctly. I remember this. I'm going to switch it. So what we brought all these in and we ranked all these firms on these ratios. And we came up with an overall ranking for each firm. So this firm right here, Costco, was the best firm in our model. Our model loved Costco. But it's also the third most expensive one. Our firm didn't like Cisco, but Cisco's the second most. Oh, I'm sorry, I'm looking in the wrong place. All right, let's look at Costco. Ignore this column. I'm gonna. Oh, sorry. Ignore this column. All right. So we rank Costco the third best company and the most expensive company. Now I got it right. So Costco, our model loved Costco, just like I do. But they were the most expensive. When we ran this model, it's been a while, Walmart was our best company and it's the fifth most expensive. So which of these companies would you rather have, Costco or Walmart? You want the best company out there that's the fifth most expensive, or the third best company that's the most expensive? Walmart. I'd rather have Walmart. What about this firm? Seventh overall, Albertsons, but the 17th most expensive. So pretty cheap company. And so what we do is we chart it out. We put our rankings versus the valuation. And what we're looking for are firms that we rank high but aren't so expensive. And so we get this type of chart. It's really easy to set up. We set it up in Bloomberg. I can't show you the Bloomberg because you got Bloomberg formulas, but you can run this on a Bloomberg machine. I might be getting Bloomberg anywhere here pretty soon, so I can start doing Bloomberg stuff in class, which would be pretty cool. So there's one model that we built. Here's another one. This is for materials. So same type of models all the way across. This one was interesting. It put 48% in price the book and 52% in EV the sales. So it's kind of interesting for materials. And then our final model, we rank this firm second, and it's the second most expensive. We rank this firm first, third most expensive. I don't know what firm that is. Sherwin-Williams, they just come out with earnings. Wow, we should have bought Sherwin-Williams. Have y'all see Sherwood? Sherwin-Williams. Can you tell that they just released earnings? It's a pretty good jump, isn't it? I don't know why it's blowing up on me here. Anyway. But yeah, the market really loved their earnings. So it loves Sherwin-Williams. Really love this stock, right? Fourth best, PPG Industries, and the 15th most expensive. So you look at the chart again, and you're looking for firms like this PPG. What I usually do, and we do a buy, hold, sell list. What our buy list says is we want firms to rank in the top 15, and they can't be overvalued. They got to be at least equal to the ranking. You could make this -3 and say, I want firms that are in the top 15, but they're three cheap. So this one was ranked in the top 15, but their valuation difference is 11. They're ranked 15th versus 4th. So they're on our buy list. So we set up a buy list, we set up a hold. I don't have the hold list and sell list in here, but we set those up so we know whether we want to buy the stock, hold the stock, or sell the stock. What a buy means is if you don't own it, buy some of it. If you own it, buy more of it. A hold means if you own it, don't sell it. If you don't own it, don't buy it. A sell means if you own it, sell it. If you don't own it, don't buy it. All right, so it's buy, hold, sell list. But these models are really easy to set up. There's Ecolab's, one of my favorite companies, but I don't think our model loved it all that much. Our model loved it, but so did the stock market. Our model ranked it second, and the stock market ranked it second. So not much opportunity there. And we got an R squared of 79%. So our model is explaining, you can explain the volatility in our rankings. You can explain 79% of the volatility in our rankings by looking at the volatility and their valuation rankings. So that's a pretty good R squared. So if you never built a model like this, you can do it. You can do this in Bloomberg. You can do it online. A lot of them have these equity screening models, but it's hard to do this regression analysis. And one thing you can do in Bloomberg is this thing called FTW. Factors you watch. It's a pretty cool function in Bloomberg. You bring in an industry there, it brings up a list of factors and it tells you over the last 5 years, over the last 10 years, which of these factors best told you what was going to outperform. Was it growth in earnings per share? Was it inventory turnover? What was the factor? And you might look at the factors to watch and say, wow, this factor is really important. I'm going to add that to my model. So factors to watch. It tells you how important the factor was, what its R squared was, and which direction too. Do you want it to be higher or lower? You can bring that into your model. So factors to watch in Bloomberg is a really, really cool function. Helps you give some ideas on factors, and they have every factor you can think of in their models. So it's really, really good. And you can sort it by relevance. Which factors best tell us what stocks you're going to have done? And that it's looking in the past. So it tells you what was the market most focused on the last 10 years. But that might be true in the future. So at least make sure you're not missing something really, really critical. So those are screening models. You go to my YouTube site, I have a Bloomberg playlist, and it shows you how to do that. So there's two ways to do these models. There's regression models and there's ranking models. I watched the Motorins class at New York Stern. He does a regression model. I think, I hate to put this on video, but I think he cheats a little bit. His regression model works really, really well. But if you try a regression model, you're going to find most of the time it doesn't work. And the reason it doesn't work is when you run the regression model, you get these slopes, and your slopes have to be going in the right direction. So if you're doing revenue growth, you'd expect the slope to be positive. When you firms with higher revenue growth have higher valuations. If you're looking at debt, it should be a negative slope. Firms with higher debt should have lower valuations. So you run the regression and then you look down and you say, wow, firms with high debt have a positive slope. You can't use that model. You can't have a model that tells you you're willing to pay more for firms that have more debt. Just doesn't make sense. And you got to look at your p-values and your f-statistic and all that kind of stuff. We do a ranking model where we tell Excel, rank the firm on all these factors and then weight the ranks based on what most tells us going on. So if you got a model where we say turnover, higher turnover should be higher valuation, and the model says no, lower turnover gives you a higher valuation, it's going to allocate 0% to that factor and just completely kick it out. So what you find out when you do regression, you do like 10 things, and 8 of them have the right slope, and 2 of them have the wrong slope. So you take those 2 out, rerun your model, and guess what? The next time you run regression, one of the 8 slope goes the wrong direction. And now you got to fix that when you end up chasing your tail. It's just frustrating. In his class, he shows a model that's perfect. Everything's lined up. All the statistics are right. I've never gotten the model work like that the first time. So I don't like regression models. So you can certainly do it. We could do a regression model on what I had built here. I probably shouldn't do it. I probably shouldn't do it in class, but I could take all those factors I did and make them the independent variables. I could take EV, the revenue, make my dependent variable. I could run regression. You could do multi-factor regression in Excel, and it would tell me the slopes and intercepts for each one of those, and you could get a precise EV the sales for each one of those companies that you should expect. But you got to look at those slopes. You got to look at those P statistics. You got to look and see what's really important on the regression. The nice thing about the ranking model is if a statistic's messing up the model, it just allocates 0 to it. You don't have to worry about it. It kind of takes it out of the model. One thing we do make sure, though, is when we look at the weights, I want something on turnover. I want something on margin. I want something on return on capital. I want something on risk. I want something in all 4 boxes. Now, if it's a retail firm, I want a good 40, 50% on margin because that's really critical. If it's a tech company, I want 30, 40% on turnover because that's really important. So there are certain things I think are critical. If I were doing a bank model, I'd probably bring in some of the tier 1 capital ratios. I'd bring in loan to deposit ratios, their loan charge-off ratios, those kind of things, and put those on those different categories, their net interest margin. So I'd have those different categories, but I'd want some in each one of those categories to make sure I'm not missing something important. But it's pretty easy to build a model. They are pretty insightful. I think it works a lot better than the online type of models. The Bloomberg has something called EQS, which is their screening model. You could try it, but you don't get much control over it. It'll tell you, I want firms that have high turnover, high margins, low debt, and PE ratios below 20, and it'll bring all that in. But you're not sure there's any statistics behind that. You may be doing something that the market doesn't care anything about. So I like having some statistics behind it. Another problem I've seen with these, one of my students, William, he came to me so excited. He had a model with an R squared of 99%. I said, wow, that's pretty good. I'll look at it. Well, one of his independent variables was essentially price. When you use price to try to forecast price, guess what kind of R squared you get? You get a really high R squared. So you can't have anything. That's why I said I'm really worried about volatility and price volatility and betas, because price is a big part of those inputs. So you're kind of using price to forecast price. So I think that's a little bit of an issue. So you got to be careful on that. If you get a really, really high R squared, probably one of your independent variables is not a good variable. You're using price to forecast price. That's just not a good way to do that. All right. All right. So we'll see if y'all remember anything. So here we go. What is that one? Don't say it out loud. Write it down. I'll pay $10,000 and it gets all of them right, unless I change my mind later. EV to EPS. Just write G or B. I should do this as a clicker, right? Maybe I should do a clicker. It takes too long to set up a clicker. All right, someone on the front row, say your answer. Dad, okay. Which one was, who owns EV? Just say both or stock. Both. Who owns EPS? All right. Don't say it out loud. Just write it down. Second row, someone in the second row, good or bad? Good, right? Who owns both of those? Stockholders. Let's say it. Just write it down. All right, third row, someone in third row? I heard good. Any other answers on the third row? Who agrees with good? All right, we'll come back to that one. I don't hear a lot of confidence on that one yet. Fourth, 1, 2, 3, 4. Okay, don't answer yet, but fourth row, I'll let you answer, but wait a second. Y'all don't even know what that is. Our fourth row, what is that? Who owns both of these? Both, right? Fifth row? Bad. So what do y'all think about price of sales then? Any? Yeah, that one's bad. So be careful on that one. Anytime you see revenue or sales, make sure you're using EV. All right. First row, what would you use for grocery store?
EV revenue.
Rev, okay. Second row. There's the book. Third row, semiconductor firm. Right on the third row is looking down. Like say tech, does that help any? Fourth row, want to try it? Be the most logical one. Life insurance company, fifth row. You take yours back there. Okay. All that first row, y'all want to have a different opinion? Does it help? Fifth row, I'll give you that shot. Does it help if I say this is like financials? What do you use for financials? Price to book. Yeah. Yeah, insurance companies just price to book. Trust me on that one. It's price to book. That's my industry. That's where I worked for years and years. Price to book. Second row, copper producer. Price to book. Yeah, commodities. Third row, a REIT, real estate investment trust. Financial company. Price to book. I mean, think about a real estate company. So, you're talking about NVIDIA. What's on NVIDIA's balance sheet that has to do with their business and their sales? Not much. But what's on a real estate company's books that relates to theirs? Well, it's the entire business, isn't it? It's all the real estate they own. It's their hotels, it's their businesses. So price to book. So a bank, what's on a bank's balance sheet? It's their loans. It's all that kind of, there's the deposits. Everything that has to do with their business is sitting on their balance sheet. Everything a REIT has to do with their business is sitting on their balance sheet. So price to book is what you want to use.
Did you just mean like investments to assets?
If you wanted to do EV to assets, it's possible. I don't know if I've seen that. You can look in Bloomberg if they have that account. This is more of BlackRock. We probably use EV to AUM. That would be more likely to use. EV to assets, it's possible, but not as likely. Now, like utilities do price to book, but they actually do EV to regulatory assets. So that's the more common for utilities. I won't give you that on the exam, but regulatory assets, those are the assets they officially can price their rates off of rated regulators. So that's a ratio. You can pull that ratio in. If you have a bunch of tech companies, you can get a lot of NAs, but if you bring in all utilities, you'll get factors. So there are some unique ones to each industry. Boy, I'm running out of industries to talk about. I can't think of, but you're getting a sense of it, right? So you get hopefully getting a little better. We'll practice when we do the team competition, so you get a little more. Also, what we'll do is we can't have a class during study days. That's not allowed. So I can't have like a study session. They won't let me do that. So what I do, I don't know if it's cheating. Y'all could probably get me in trouble, but say we're no study session, but I'm going to do office hours. I'm going to do my office hours on Zoom. And during my office hours, I'm just going to happen to be working through the prior exam for this class and recording it. If you just happen to be on that Zoom, I mean, that's your choice. There's nothing official. I'm not announcing anything, but if you just happen to be there listening in, that's your choice, but it's just my office hours. All right. So that's how I get around the study days. So do you think that would get me in trouble? That doesn't sound too risky because I'm not making an official study class. And then if you can't make it, you can see the recording of it afterwards. So I will work through it. So you'll see one of these questions for the team competition, and then you'll see one for when I do the review video. But also, have y'all been looking at the video preparing for the team questions? That helps a lot, doesn't it? It gets you ready for the exam, so that helps a lot. So, all right, so where do we go from here? Any questions on relative value? It's really a pretty important concept in investing. You really need to know it because we do this quite a bit in finance. It's pretty dominant. All right, so where I want to go here is a quick discussion on portfolio management. We'll do it fairly quickly, but there is one thing in here I want you to be aware of. Y'all have heard this term pitch book. And there are websites called pitch book, but this isn't the pitch book I'm talking about. So you be real careful. The investment society did a class on pitch books, and I was real uncomfortable during the entire class because I didn't agree with the way they were doing it. So there's two types of pitch books. You get the pitch book from the investment management side. That's when they're pushing some case. They want to do some merger or some spinoff or some acquisition. That's their pitch book. On the investment side, it's very, very different. And you can't actually find these online usually. They're usually proprietary. I've tried so hard to find them. I have several. I'll show you some, but they're 15 years old. I took as many as I could when I left UTSA, so they're really old. I've called some of my buddies in this field and say, can you like send me one from 5 years ago? And they're like real skittish about sending them. Plus they don't have any. They throw them away pretty fast. So I can't show you recent ones. But I'll show you some older ones. But what a pitch book is all about, and we'll get into this, is all about, you need four things, I guess, really. You need philosophy, process, construction, and risk management. So we're going to talk about that. If you're going to go on the investment side, so don't hear the word pitch book and go talk to BlackRock and think that kind of pitch book, because it's not the investment banking side. For a pitch book, and I actually recommend you do your own pitch book for yourself personally. What is your investment philosophy? What is your process? We just talked about it here, using the computer to screen for stocks. That's a process. What's your construction? How do you decide how to buy stocks? So you can put 1% in the stock, 2%, 5%. How are you going to do that? And then risk management. And most important thing on risk management is your sell discipline. When did you decide to sell a stock? So I showed you our process. I didn't show you construction, but I showed you process and risk management because I had a buy, hold, and sell list. And our risk management is if a stock goes on a sell list, we have to sell it. There's none of this, well, we have to sell it, well, unless we do some analysis and it's okay. No. And I can tell you, when I interviewed investment firms, if I asked them, what is your sell discipline? They all cleared their throat and sat up straight, and they got real serious because they knew I didn't want a bunch of kind of wimpy, we usually sell it, but sometimes we don't. No, it's like, because this is where the emotion gets in. What's the problem with the sell discipline? Sell discipline means you got to sell a stock because you lost money on it, you made a mistake, and most people don't want to admit they made a mistake. So they don't want to sell it. They want to hold on to it, hoping it comes back. You need a strong self-discipline. You need something that tells you, you were wrong, you messed up, sell that thing. You obviously don't know what you're doing, get out of it. So that's your risk management side. So anybody tell me those 4 things? How good is your memory? Number 1, you need a what?
Philosophy.
Investment philosophy. Number 2, process. Number 3, construction. Number 4, risk management. All right, so we'll talk about that next class. And you can start, I really encourage, if you're going to invest, you're going to interview with an investment firm, to have somewhat of an idea what you believe on that. All right, we'll stop it there.